on that data. The bond market has had a sensational rally this week. Does that come to a crashing halt at 7:30 a.m. Eastern Time this morning? Let's find out. We're joined now by Markets Live Executive Editor Mark Cudmore. What do you think?
Guy, I think you've lined it out perfectly. I think we are set up for an asymmetric reaction to the top side if there's a bit of a beat today. I just think we've had a great run in bonds. I think, as you said, the whisper numbers for softer again. We've kind of got into this momentum trade in longs. On the future side, we've seen kind of shorts move to longs there. So I think, you know, without having any particular insight on the number itself, I think there's likely to be a bigger reaction on a topside beat than there is if there's a miss to the downside in terms of yields. That said, I don't necessarily think we're going to change the narrative in yields. I think the backdrop still remains the same. We've got about two cuts priced for the Fed for the rest of this year. I think that's about right. I don't see us pricing in much more, so I think we're bottoming out in yields here in the short term in the front end. And I still think, I've been wrong on this repeatedly, I still think that ultimately to the second half of this year, the curve should steepen at some point, but there's no sign of that just yet.
So what do you do with equities this week? So if we're bottoming out on this yield story, which seems to have had an impact on the equity story, is this also the time to maybe flip the equity story, at least tactically short term?
No, I don't think so, actually. I think equities will continue to do okay for the next couple of months. I think that the backdrop, the macro picture is still good, and we've got through earnings season. And so from the bottom up, the AI bubble, and I use the word bubble intentionally. I think it's early in that stage. It is not set to pop anytime soon. All the earnings guidance show that there's still a lot of money pouring into this sector. So I don't think there's a bottom-up disruption. And I think from the top down, the fact is central banks, Canada and Europe showed us this week, central banks have a dovish reaction function. They're keen to cut given half the chance. And therefore, I think if yields bounce, sure, short term that's a little bit higher for stocks. But next week, stocks will just go higher again because overall rates are not tight in the US relative to the strength of the economy. They're not particularly restrictive policy in the US like there is in the Eurozone.